That's great.
Okay, so let's get started. This spreadsheet, it's for evaluating rental properties. So I have a different one for calculating a flip deal, if it's a deal or not. This particular spreadsheet is for evaluation of a rental property, and also gives you the ability to compare multiple investment properties. So if you're looking at multiple rentals, to see which one is a better deal. Yeah, allow you to compare two similar houses, or a house and a duplex, or whatever, two duplexes, to figure out which one is a better deal. Yeah. So I'm going to go by from top down. The yellow columns are the ones that you can edit, are the ones you can come and modify and enter something. Yeah. Whatever is not yellow, it's a calculated field, and you should not be able to modify it. You should not modify it. Okay. So the first one, which is in row 3, it's the MLS number. It's just for informational purposes. If you are tracking a property that you find on MLS, you can put the ID there. Next cell, it's also informational. It's if it's a short cell, or if it's a regular cell, or if it's a bank REO, you put it there. It's not affecting it's not playing anywhere in the calculation. In row 5, you have the address. Whatever you enter as the address is gonna also get displayed bigger in the green field in row 2. But it's basically the address of the property, and that's the one I use mostly to identify the property. Then you have the number of bedroom and bathrooms. The way I have it set up, I'm looking for 3 bedrooms, 2 bathroom houses. Something less is going to be flagged as with red. But again, it's not really, it's for your information. The next 4 fields have more importance. One is the square footage of the house, and that it's used to calculate the price per square footage. There is the lot size. How big is the whole land, the property lot? It's not used anywhere, but if you care for a big yard or for a big lot, you can. That's where you enter it in. And again, you have coloring based on the criteria that you have. Same thing for the year build. If you're looking for specific ranges of years, you'll color accordingly. And then you have the ARV, the price or the ARV. The price being either where the property is listed, where it's basically what the seller is expecting, or it could be the ARV. It could be where what the property is it will be valued after repair, because that will be used further down where you have a BRR section. But most of the time it's the listing price. If you think in terms of MLS, is the listing price. Yeah. So once you enter it, it's going to calculate a bunch of other stuff. Yeah. So if I'm going to a new, I'm going this column L. Yeah. I'm going to skip the MLS information. I'm going to skip the short sell or regular. I'm just going to enter an address, because it's used for me to track the property. I can skip the number of bedroom or baths. I'll enter the square footage because that has relevance. I can skip the lot size. That's informational, but let's say you care 7,000. It's a decent sized lot. I care for the year. Then the most important is the price. Yeah, let's say I put 225. The moment I enter, it's going to calculate the down payment. Yeah, it's going to calculate the loan amount. It's going to calculate closing costs. It's going to tell you about reserves. It's going to tell you how much money you'll have to bring. It's going to calculate the price per square footage. Now, how are those calculated? If you go all the way down, that's based on some settings that you predetermine. Yeah. So here you have a whole, it's a section all with settings. So let's talk a little bit about that. This rate is the loan rate. It's what you expect that you will be able to finance this property. Yeah. So right now I have 7% interest rate. I'm also considering that it's going to be a 30 years loan. 30 years expressed in months. So it's 360 months. Yeah. Based on the rate and the duration, the terms, the loan duration is going to calculate a loan factor. That one, it's used to determine the principal and the interest allocation. So this cell, it's calculated, and it's depending on the rate and the number of months. The next one is the down payment. These settings, most of the time you set them and you should not mess with them that much. You know, you should not tweak them. They are pretty much set unless, let's say, the interest rate change and
goes up, right?
increase them, or you get some better financing, and you can get, but otherwise you pretty much determine that the best financing you can get at this moment, let's say it's 7%, that's the rate you're going to use. Right? If it's a conventional loan, it's going to require 25% down payment. That's what you're going to use. The reserves required, that's there for two purposes. Some banks require reserves. If this is an acquisition that you make into a self-directed IRA, being a non-recourse loan, the bank requires reserves. And generally speaking, it's good to have some money aside. It's good to...
And as you get more and more loans, don't they require you to have more and more reserves also?
Yeah, but it's not good to basically put all your money into a deal and not have, because you can have repairs from the second day of ownership, right? You can have a storm and then you'll have to repair the roof. So it will not be wise to go, completely zero money reserves. Now that being said, the reserves are not calculated. I think in the version that you have, they will be calculated in this line, but they are not factored. I don't know if in your version, if it's required in the total funds required. Regardless, if you don't want to use it, you can.
Yeah, it has reserves in it.
The next line is the insurance. If you're looking at the similar type of properties, all of them should have similar type of insurance, right? And next one is property management. The next one is property management, and it's between 6 and 10%. If you find a very cheap property manager, maybe you can use 6%. Nowadays, the majority of property manager around here charged 10%. I heard some of them go to 12%. I use 8%. It's somewhat of a compromise. And even if I'm doing self-management, I still consider 8% for management, because in the idea that for two reasons. Sooner or later, you might want or you might need to have somebody else manage this property, and you'll have to pay them, either because you will go on vacation or because you have enough of them that you no longer want to manage them.
Right.
Second reason is because even if you do it, your time, it's money. You should be rewarded for the time that you spend for managing this property. And even if you are not actually, pocketing the money, you're just saving the money, regardless, you should factor it in your calculations. It's if you really want to, go lean, probably you can put it to 0% or lower percent, but I would advise against that. Now, 8% also represents, there is a vacancy. On the vacancy, we usually use 8%, and it's similar idea. You will have vacancies. 8% represents 1 month a year. The idea being that most of the leases end at the end of the month, and you'll have to do a make ready, especially if you're at the beginning and you're not that expert at changing tenants and being able to do it on a very short period. It will take you several days to fix the property, make repairs, maybe paint, maybe clean the carpet. By that time, you missed the end of the month, the beginning of the month. You'll have to wait at least till the beginning of next month to start a new lease contract. So right there, you have 1 month. You have 8% annual vacancy. You might have even more than that. You might have that every 2 years. You might not have it every year, but you might have it every 2-3 years, and you might have it every 2-3 years for a couple months. In the end, you'll still come to an average of 8% a year. If you get really good at property management, or you have a very good property manager, they might be able to go one after another. But again, my advice is to use 8% for vacancy. The same idea, when you have a vacancy, you're going to have to pay utilities. You're going to have water, you're going to have garbage in that 1 month of vacancy. You're going to have electricity. So I usually put at least $200. If you want to have a warranty contract on the house, you put it here. Also, if you want to have repairs and incidentals, you need to account for that. You're gonna have repairs and occasional surprises. These two go hand in hand, and you can look at another way to look at it. You'll need to put money aside for capital expenses, reserves, which are big items that you have to put little by little aside, and then you'll have roof replacement, a big chunk at one time, and that's different from small repairs. So that's why I have this. I call it warranty, and I also have repairs and incidentals. But think of it as like short-term repairs, long-term repairs.
Right.
And
The roof and the HVAC and all that stuff. Yeah.
yeah,
Maybe foundation there.
These are annual. Yeah. These are annual expenses.
Okay.
So based on all this stuff gets calculated. Yeah. So back to our example, that's how, based on the rate, based on the down payment amount, that 25%, this down payment gets calculated. Right? Based on and then the difference is going to be the loan amount. Closing costs. The closing costs are calculated. There is another section on the closing costs. These are also numbers that you can play, and depends on your title company and your, but usually amounts to about 2% of the purchase price. You might have to pay some origination fees. You might have to pay. You'll pay for underwriting. You'll pay for processing. You're going to have an appraisal. The insurance reserve, tax reserves are taken from this insurance and also from the taxes that you'll enter. And then you might have closing costs, title insurance. You might have a recording fee, flood fee, attorney fee. It's going to calculate. You can tweak them, but most of the time it's about 2% of the purchase price. So based on that, you end up with this line of closing costs. The next one is the reserve. Is that percentage? Right now is nothing. If we go and change that, we put let's say 10% reserves. Suddenly we're going to have reserves. Yeah.
Okay.
This will tell you. This line will tell you total funds required. So basically, how much money you expect that you'll have to put on the deal to have. If you purchase at this price, you'll put 25% down. You'll have this loan amount, this. And if you look, you'll see what it represents. It represents the closing cost total plus the down payment amount plus the reserves. Yeah.
Okay. Yeah.
Okay. So next thing that you'll enter is the taxes. Yeah. You figure out the taxes. You just have to be careful to make sure that you are not looking at taxes with exemptions. But here is where. Right. So let's say the taxes are $4,500. Yeah. Again, a bunch of stuff gets calculated based on that. If you have HOA, let's say the property it's in a HOA. Let's say you have $22 monthly HOA. You enter it there. Let's say then you have to enter the rent. This is very important. Yeah. The rent, let's say it's $1,475, the potential rent. Yeah. That's pretty much all it's needed to do calculation, to do a full set of calculations. Now, I also have this rent range. When I look for the rent potential, I qualified from 3 sources. I look at the rent range. It's a website where you can pay for, let's say it was $8 for a report. It's going to give you a full report on rent potential, market saturation with rentals and averages. And it's a website that helps you figure out the rent. I'm also using Rentometer. So let's say rent range says it's $1,450. rental meter says I can go all the way to 1,500. Yeah? Rent's estimate is the one that Zillow gives me.
So, right.
Zillow says it's 1,460. Yeah. So I just put them informational, and based on them, I can make it's a subjective determination, but maybe I run my own CMA, and I decide, okay, I should be able to get 1,475 rent. So that's the rent that I'm gonna consider. Yeah. Now the spreadsheet, like I said, allows you to compare different properties, but also allows you to compare different scenarios. Because let's say I have the same property at 225 purchase, yeah, same conditions, the taxes will be the same, the HOA will be the same, but let's say I'm optimistic and I think that I'll be able to get 1,525 rent. Yeah. So then I'll be able to compare my numbers on 1,475 rent or 1,525 rent. Right? All things being equal, what happens if I get better rent? Right? So anyway, once I enter the rent, it's going to calculate the gross annual rent. Yeah. It's the rent multiplied by 12. Yeah. How much rent I get the whole year. It's going to calculate the operating expenses. The operating expenses are the taxes, plus the insurance, plus the HOA, plus the property management fee, plus the utilities, warranty, plus the repairs and incidentals. So you can see it all the way here. Yeah? So it's going to tell you how much you have in operating expenses. The difference between how much you get in rent and operating expenses is the net operating income. Not to be confused with the cash flow or the net annual income. From the net operating income, you will have to pay the mortgage. Yeah? And you're gonna get, because you already know you enter the interest rate, you enter the duration of the loan, based on the down payment, the loan is calculated, and you'll calculate and it'll tell you the principal amount that you pay, the interest that you pay, and the monthly principal and interest. So that's basically the mortgage payment. And based on that, you have this much annual mortgage payments. Yeah. That mortgage payments get subtracted from the net operating income, and you're going to end up with the net annual income. And that's basically the annual cash flow. As you can see, for these properties,
not so good.
at 225, the net annual income, it's a negative 5,500. If the rent is a bit better, it's a negative 5,000.
Wow.
Clear so far? Any questions?
Nope, I'm good on everything.
Okay, so let's go back. As you can see, a lot of stuff is colored with red, green, and background and all that. How is that figured out? That's based on settings that you have that you can go and specify. Yeah. So for example, here I can put my preferences. If I'm looking the way I have it, I'm looking for a property. My ideal property is going to cost me less than 160,000. If it's between 160 and 170, it's going to be okay. I'm going to have a light green or an olive green. If it's above 170, it's going to be orange. If it's above 180, it's too expensive already. It's going to be flag red. And obviously, you can see the price to 50. Let's say I drop it to 165. Suddenly, it's marked as green. Yeah.
Mm-hmm.
So same idea applies for price per square footage. If its price is great, the house is big, it's gonna. If it's price per square foot, it's below 90, it's gonna be marked green. If it's above 120, it's going to be marked red. Based on the home size, whatever, if you're looking for a big size or whatever you consider to be too small, big, medium, whatever. Same thing for the lot size, for the year build. Yeah, for example, I consider that if it's less than 2000, it's not that great of a house. If it's between 2000 and 2003, it's orange. 2003 to 2006, it's okay. Anything about 2006, it's perfect. Right? And again, same idea for taxes. You set the parameters, the HOA, the rent, the operating expenses, cap rate, cash flow, return on investment, what you consider. I consider if it's less than 550, it's bad. If it's 550 to 7, it's orange. Above 7, it's okay. Above 9, it's great. Right? And normally, it's basically you determine your investment criteria. Your investment criteria should include all these parameters. And once you set them, your spreadsheet is going to get colored according with your preferences. And you'll be able to judge quickly which one represent a good investment or not. For example, I just look at this one, it's full of red. I look at this one, it's full of red. This one have some greens in them.
It's getting better.
That means I can discard these ones and I need to concentrate on this one, right? So back to our properties, the two properties that we entered. Once I enter the rent, it gets calculated. The rest of the stuff gets calculated. And now I have 3 sections. I have a section for purchasing at that particular price. Yeah. Then I have a section for purchasing at an ideal price. And I have a section for if I do a BRR deal. Yeah. So let's take them one by one and discuss them. Yeah. This one, I repeat. I repeat the price or ARV just to have it there. There's nothing but a copy of the one above. Yeah. I repeat the out of pocket. How much money do I need to bring on the table to get it at 225, to close on at 225, to get a loan of 25% up to 25. It will tell me how much money I need to have. It will tell me the net annual income, which again is a repeat of this line. If you divide that by 12, you're going to end up with a monthly cash flow. Obviously, you're shooting for positive cash flow, and ideally more than $100 per unit. Yeah. It's going to calculate the cap rate. It's going to calculate the cash-on-cash return on investment. It's going to calculate the debt service coverage ratio, and it's going to calculate the gross rent multiplier. And each one of them are explained. If you go and hover over them, it's going to tell you the definition. How is the cash flow defined? What does it represent? How it's calculated? What's the cap rate? How it's defined? What it's used for? How you look at it? What's the cash-on-cash return? What's the debt service ratio? And how it's used. Basically, you're shooting for 125 or higher. Then what the gross rent multiplier is and how it's used. This one, it's gross rent multiplier, the lower the better, and it's used primarily for multifamily. It's not so much relevant for single family rentals. That becomes very relevant for multifamilies. Yeah.
Oh, okay.
So again, if we compare these two properties, you can see clearly which one, this one, negative cash flow, low cap rate, obviously negative return on investment, very low debt service coverage ratio, very high GRM. Compared with this one makes some money a year, actually makes good money, good cap rate, decent, not great, but decent return on investment. The SCR is above 125, good gross rent multiplier. Yeah. If we look at our properties, the one with 1475 and 1525 rent, this will not cash flow regardless of the rent.
Right.
Yeah. So one way I can play is, okay, how much rent do I need? Let's see, at 1700, still not cash flowing. 1800, still not cash flowing. At 1900, still not cash flowing. As you can see, the rent will have to be somewhere above 2000 to transform this into a barely cash flowing property. Mm-hmm. Obviously, that's not going to, I mean, you cannot really play like that because the market, the rent it's pretty much, it's determined. You don't have that much play. And more than that, my advice is if you go by the three values, you should go by the lower or closer to the lower end than to the higher end. Because the reason is if your property is good and your rent it's on the lower end, not on the higher end, it's going to rent fast. Your vacancy is going to be low, and vacancy it's a big time killer of cash flow. So,
right.
Instead of being optimistic and hoping that I'll be able to squeeze 1525, probably you should go even 1450. And if it's a good deal, it's going to be a good deal. Obviously, at 225, this property is not a good deal. So let's play. Let's see what price where it makes sense. Yeah. Let's see what happened at 200,000. Let's say I get it with a 25,000 discount. Still not good. Let's say 175,000. Still not good. 150,000. Still not good. 140,000. Still not good. Okay. So at 120, I managed to make $500 a year. I managed to make $500 a year. Now, you might wonder what's the deal or how the heck. There are two reasons why it's like this. It's because of the big taxes. This property has $4,500 in taxes. It has an HOA, and because of the rate, the interest rate. Let's say I can get a conventional loan in my name, and the rate I can get is 4.75. Yeah. Now, if we look, I have 2,000 a year, so probably I can go all the way to 180 at 170. 165. That's where basically breaks even. At 164, with that tax rate and 1450 in rent, sorry, with that property tax, that HOA and that rent, this is where it breaks even, 164. So basically that's the price where I need to make my offer or where I need to get it.
Okay.
That's where I break even. I'm not losing money. I'm not gaining money. I get the property and move. No. Obviously, it says here ideal 740, 1040. What it means by that, I should shoot for a cap rate above 7 and a cash return above 10. So again, to get to that point, I need to have get it in much better conditions. Pretty much I need to get it at 50% of value to get anywhere near the 7% cap rate and decent cash flow and all that. So again, this shows me what my offer should actually be to have a break-even property. But let's say you can get the house and you can do a BRR. You can rehab it. It's in bad shape. You can rehab it. You can lease it, rent it, and you can refinance and get most of your money back, right? So here you're going to enter the acquisition price. Let's say it's in bad shape. Let's say I'm able to get it at $120,000. Yeah. Correction. It should include the price that you are able to get it plus the repair. So let's say I can get it at 120, and I can put 25,000 and make it nice. So it's gonna cost me 145,000. Now, at 145, if it appraises at 225, at ARV 225, I'll be able to refinance and get most of my money back. Actually, more than that, I'll be able to get 16,000 extra in money back. Problem is, because of the rent, because of the operating expenses, the taxes and the HOA and all the other insurance, vacancy and all that, it doesn't cash flow. Why? Because the rent is relatively small for the operating expenses. Yeah. Problem is, the operating expenses, the cash flow are not dependent on the price. As you can see, I can get my money back, and I can get even money out of the deal, put in the pocket, but it's not cash flowing because, again, it's based only on the expenses and the mortgage. The mortgage is still going to be based on the loan amount. Yeah, and the loan amount is 25% of 225. So if I get that kind of money out, my mortgage is going to be fixed at the same $880 a month, plus taxes and insurance. This will be my cash flow, annual cash flow and monthly cash flow. Obviously, it's negative. The cap rate, it's poor. The return on the investment is negative. And in terms of a straight debt service coverage ratio, is going to be pretty lousy. And again, primary here, the last row is the operating expense ratio. And you're shooting for something, the lower the better. We have here the definition. As you can see, it's pretty big, 42%. 42% means 42% of your income goes to cover operating expenses. Plus,
okay.
So you can imagine you have that plus mortgage payments. That's the reason why you don't have anything. Sorry, for the property that we're discussing, it's 48%. So almost half of all the money you get goes to pay taxes and insurance and all the other operating expenses that you have. Right?
Okay.
The last row it's comments. It's something for you if you want to put some notes. For example, I like to track the Zestimate value. I put it there. So that's about it. Again, the idea is you'll be able to play with the numbers and see how things look in a straight purchase scenario, in a discounted purchase scenario, or in a BRR scenario where you get it, you rehab it, refinance it, pull most of your money back or even more, and you'll see how if you cash flow or not, and how it goes. Any questions so far?
Nope, you explained it pretty well.